This is Sovrun, your guide to financial literacy. Today, we're separating skill from riding the wave. In 2023, the AI rally sent tech stocks soaring. Fund managers with heavy Nvidia and Microsoft bets looked like geniuses. But were they actually skilled, or were they just riding a high beta wave? The Treynor Ratio. Treynor Ratio answers exactly that. How much return are you earning for the market risk you can't escape? The Treynor Ratio focuses on one specific kind of risk, market risk. When the whole market drops, every stock feels it. You can't diversify that away. The Treynor Ratio asks, for the risk you can't avoid, are you getting paid enough? Think of surfing. You can't control the ocean. Those are the waves everyone faces. But you can control how well you ride each wave. A great surfer gets more out of the same wave. The Treynor Ratio measures exactly that. Here's the formula. Treynor Ratio equals your portfolio return minus the risk-free rate, all divided by beta. Beta measures how sensitive your portfolio is to the market. A beta of 1.0 means you move with the market. Above 1 means more volatile. Below 1 means less volatile. Let's walk through it. Portfolio return, 15%. Risk-free rate, 4%. Excess return, 15 minus 4 equals 11%. Portfolio beta, 1.2, meaning 20% more volatile than the market. Now divide 11 by 1.2, and you get a Treynor of 9.17. Compare that to the Sharpe ratio. Same numerator, but Sharpe divides by total volatility, while Treynor divides by beta only. Here's where it gets revealing. ARK with a beta of 1.5, Treynor of just 4.0. A lot of that return was simply amplified market exposure. The S&P 500 with a beta of 1.0, Treynor around 6. A boring value fund with a beta of 0.8, Treynor of 7.5. Better risk-adjusted returns with less market risk. And Berkshire Hathaway with a beta of 0.7, Treynor of 9, the highest. Lower beta, but genuine stock picking skill. During the 2020 to 2021 bull market, ARK had a beta of about 1.5. Every 1% market move translated to 1.5% for ARK. Raw returns were spectacular, but the Treynor Ratio told a different story. Much of the performance was just amplified market exposure. Now compare that to Berkshire Hathaway, beta of 0.7. Lower market sensitivity, but a consistently strong Treynor Ratio. The returns came from stock picking skill, not just riding the wave. Here's the key insight. Some risk can be diversified away. Company-specific events, earnings surprises, you can spread that out. But market risk affects everyone. The Treynor Ratio tells you if you're being compensated for the unavoidable risk. Skill or just riding the wave. The Treynor Ratio knows. And the Treynor concept isn't just for investing. It's used in insurance for pricing systemic risk, climate science for measuring global versus local warming, and epidemiology for pandemic versus endemic spread. Follow Sovrun for more financial insights.